Hi, I'm Brad Johnson. I am the owner of Evergreen Capital, and we specialize in alternative assets. And I've invested over 200 million on behalf of our investor network in alternative assets. And I've also made some investments in investment grade net leasing. And so let's go over some high level aspects of triple net investing and specifically with credit tenants. So this isn't investing in random Taco Bells or Kentucky Fried Chickens in the middle of nowhere, which is what most people think of when they hear triple net investments. That world is rife with low cap rate, five cap rate deals where perhaps the broker or seller is capitalizing on somebody on the coast that's selling a property and needs to 1031 exchange, right, to save taxes. And they just want a low hassle piece of real estate that's going to generate some cash flow without them having to worry about it. But oftentimes those are not great deals. The real estate's not that great. It's just a little box for a restaurant, right? These are headquarters. These are industrial buildings that we're talking about today. These are mission critical pieces of property that are leased to credit tenants, investment grade credit. So we're talking triple B and above type of corporate credit, large companies. So their bonds are extremely valuable, very low risk. The default rate historically on triple B or better credit is 1.6%. So very similar risk profile to investing in debt. Okay, so that's a high level overview. Let's get into a couple of the benefits and a little bit more of the details. Investment grade triple net deals did extremely well in the 2008 crisis, so the great financial crisis. I was in the investment industry in that time, and it was difficult to be working on real estate deals. Tenants were defaulting left and right, but not in the investment grade sector. That sector of triple net deals did incredibly well through the downturn. As we can see by the graph, the green line is investment grade net leases, which outperformed every real estate asset class during that period of time. And once again, that's because these leases are backed by the corporate entity that has a big balance sheet. These companies don't want to see their credit hurt. If one of their leases defaults, then all of a sudden they lose their high credit rating, which is really problematic. So these types of leases almost never default. And we can see here during the credit crisis, this is literally the worst time that we've seen in 100 years for credit assets, still did remarkably well. Still had the lease payments come in on time. The landlords were still able to collect their rent, whereas so many other asset classes, it was blood in the streets. It was defaults. It was lenders taking over properties. And we just didn't see that in investment grade net lease, which is one of the reasons why we love this asset class so much, is because we feel extremely good about the downside, which is where you want to start when you're looking at an investment. It's easy just to focus on the upside. That's the fun part. But first, you got to get the downside out of the way. You got to feel very comfortable that the likelihood of this asset class going to zero is extremely remote. I think that's a prudent way to invest. Now, you might not do that if you're a venture capitalist, right? You only want to focus on the possible upside, these big home run types of scenarios if you're a venture capitalist doing seed investing in startups. But that's not what we're talking about. We're talking about an income real estate asset that is going to maintain and grow your wealth and is not going to take unnecessary risk with that principal, that initial investment that you're going to make. And on top of that, when you move on to COVID, the next real estate crisis, we saw the same thing play out. Investment grade net leases saw the same 100% collections through COVID for the most part, whereas you were seeing 80% to 95% collections on all the other asset classes, with retail being that 80% because you couldn't go shopping, right? All the way to apartments, which were in the mid 90s in terms of collections. And so we have a consistent history here of two major downturns where the rent payments just kept coming in. So that gives us extreme confidence in our downside scenario, even in difficult times, which is the whole purpose of this investment, is really an asymmetric risk return profile. And I think that's the defining characteristic of this asset class. It's that ability to get potentially great returns and you're not taking a ton of excess risk with your principal. You feel very comfortable with your initial investment and should generate great returns from those contractual payments from investment grade tenants. All right, so let's talk about what we mean by triple net or the net lease component. All that means is the tenant's paying for everything. In most real estate sectors, you, the landlord, get a bunch of rent check payments, or one if it's a single tenant, and then you have to pay for all the expenses to maintain the property and to operate the property. And so those are listed here, taxes, insurance, repairs and maintenance, utilities, G&A, general and administrative. Sometimes there's software. There's a lot of expenses that go into operating property. There's going to be a list of at least 20 different expense line items on your profit and loss statement that are going to subtract from obviously the rent that you're collecting at the top of your profit and loss statement. And then you have your net operating income once you subtract the expenses from the income. Now, to compare that to a net lease property, pretty simple. Rent comes in and you keep all the rent. The expenses, that is the tenant's problem. They are taking on the responsibility for property tax increases, insurance increases, repairs and maintenance to the building. As a former landlord to a portfolio of properties with a lot of different people living there, this is wonderful. Right? You're not getting any of the calls about plumbing problems, water leaks, weather issues. None of these things are going to impact your returns in a triple net deal. The tenant is responsible for all of those things. And so that gives you a giant layer of inflation protection on the expense side because the tenant is bearing those risks. Insurance costs have been growing at 20% the last few years. It's been crazy. With net lease deals, those bills went right to the tenant, whereas the owners of apartment buildings obviously had to take on those expenses, which eroded profits those years, of course. And the cherry on top of this is that most of the time, these leases include capital as well. So the tenant is even responsible if the roof needs replacing or the HVAC stops working, which is just a whole nother layer of protection. Because as you know, real estate is a capital intensive business. There's a lot of things that can go wrong with a property. Even new properties have things that go wrong with them. If you own your own home, I'm sure you're used to repairing things left and right that just pop up. And so that liability, that risk gets transferred over to the tenant, which lets you feel comfortable in that you're going in return once you decide on what that rent is with the tenant. That is going to be your yield. That is going to be the income that you're going to be making on that asset. If a net lease property owner buys a large industrial building for $100 million and they charge $8 million a year in rent, they know they're going to get an 8% yield because everything else is going to that tenant. So it's just a de-risked type of real estate. And so if you can think about these two different scenarios here, the left, a traditional real estate asset is going to be far more sensitive to changes in the economy. It's going to have more volatility in its cash flows, of course. It's going to be more sensitive to the asset type, the strategy, the geography where it's located, even the streets it's located on, because there's not that underlying credit tenant that's backing the leases. So it really depends on how that individual property is going to be performing. Whereas with a mission critical investment grade lease, I mean, really, if you think about it, if you have a 20-year lease with an investment grade tenant and a high rent payment, that property could be in the middle of nowhere and you could still feel like that's a valuable return stream because it's backed by, once again, that credit, which is bond-like. Of course, that's not a great idea because you could get the real estate back. So the best firms in this space focus on both the real estate, making sure that that is indeed great real estate, good bones, good location, and then also the credit of the tenant. You underwrite both things, and then it becomes a bit of a belt and suspenders protection because you have the credit of the tenant as your number one protector. That's your first line of defense. But then if they should default or leave in the unlikely scenario, because we talked about the low default rate for investment grade ratings, but should they default, you can take that great real estate and then release it to somebody else, perhaps even a higher rent payment. And so that's probably the most attractive component of this asset class is really that dual layer of protection. You feel like a lender as opposed to a traditional equity only real estate owner. And so that's what makes this asset class so unique is because normally when you're investing in real estate, you're really taking equity risk because there's a giant mortgage behind you and you have to operate that real estate really well. And normally you're leasing to, sub credit tenants that if they leave, generally you're not going to be able to pursue them for what they owe. Whereas with net lease, you feel like a lender. So you get a bit of both worlds. You get to have those contractual high income payments come in, and then you get the appreciation on top of that as if you were a normal real estate investor. All right, that's investment grade net leasing in a nutshell. If you want access to our research and these slides, go ahead and just shoot us an email, info@evergreencap.com. Thanks for your time.